We are recording.
Welcome to Inside Economics. I'm Mark Zandi, the chief economist of Moody's Analytics, and I'm joined by two of my colleagues, of course, Chris Dreides. Hey, Chris,
Hi, Mark.
how's it going?
It's been a bit of a emotional roller coaster this week,
It
right?
has. Anything in
Shut
particular?
down, shut
Oh,
down, avoided. I was ready to mark down my recession odds, and then the speaker gets ousted. I have to raise them back up. You got oil prices, going to the moon and then fall into the earth. Oh, not to mention the 10-year. We got everything moving around.
yeah, a
So,
lot
yeah,
of
yeah,
volatility out there. A lot of
a
stuff
lot of
going on.
volatility. Yeah.
Yeah. Oh, good. Well, we'll take a pulse of your general view in just a minute because we want to introduce our other colleague,
Hi,
Dante
Mark.
D'Antonio, and Dante is a regular here on Inside Economics on Jobs Friday. And indeed, it's Jobs Friday. This is October 6th, the morning of Friday, October 6th. How are you doing, Dante?
I'm doing well, thanks.
Yeah.
Yeah,
Okay. Good, because you're going to do the heavy lifting here.
I'll do my best.
Yeah. I've been following jobs reports for many years, let's say now decades, a few decades. And it always feels like once, twice a year, we get a what I would call an out of bounds jobs report, something that's way outside expectations. And this one was fortunately it was on the upside, I guess, right? 336,000 jobs created during the month, but this felt kind of out of bounds. But um, give us the rundown. What's your sense of the numbers and what it means?
Sure, I'm going to give you the sort of the straight rundown first, then we can talk about why I may, have some buyback on some of what's in the report.
Okay, yeah, that'd be great.
Okay,
Yeah, that's called expertise, right?
there you go.
Yeah,
Try to
you're
try
you're
to
gonna provide
fill that
your
in later.
insight into here's the numbers, but hey, let me tell you what the real numbers are.
Yeah,
That's what you're saying?
that's what I'm saying. Yeah.
Okay, fire away, fire away.
So we got a total gain of 336,000 jobs in September. 263,000 of that came in the private sector. We also had substantial revisions in an upward direction to the last 2 months, which is unusual given what we've seen recently. Total revisions to July and August were 119,000. So it's a pretty big shift. If you looked at the 3-month moving average of gains last month before revisions, it was about 150K. Now with a new month of data and those revisions, that 3-month average is up to 266,000, which seems like a pretty big swing in sort of expectations about where the labor market is going. Obviously there's a big jump in government payrolls, up 73,000 this month. Also some big revisions there, which we can get into a little bit later. Across other private industries, there wasn't a whole lot of note. Small gains in construction and manufacturing. Transportation and warehousing moved back positive after the shuttering of Yellow Corp sort of had a hit last month. Healthcare continues to be sort of the biggest steady driver of growth in the private sector. Leisure and hospitality maybe was the one sort of quirk there where growth jumped back up to almost 100,000 after averaging only about 40,000 in recent months. So it was the biggest increase in leisure and hospitality since January. A little bit unusual. In terms of hours worked, average weekly hours were flat, didn't change from last month. Average hourly earnings was probably an upside surprise in the sense that it was a little bit weaker than expectations. It came in at 0.2% for the second month in a row, which is obviously good news in the sort of Fed's view of wage growth needing to moderate further. The household survey was uneventful, I would say. There just wasn't a whole lot going on. You had small gains in the labor force and in employment as measured by the household survey, which left you with the unemployment rate unchanged at 3.8%. Again, that's maybe a positive news after we had expected that to come back down a bit when it jumped in August. And household survey, just not a whole lot going on. Participation was flat. Employment population ratio was flat. There just wasn't a whole lot of change there relative to sort of the big surprise on the payroll side.
So good, bad, bad, good. What do you
Yeah,
think?
I think it's hard. I think this whole good is bad right now framing makes this seem bad. I think at the outset, this is a stronger report than we expected, which is probably bad news for the Fed. In hoping
Meaning
that
the
they'll
Fed would be more likely to raise rates,
right,
and if they raise rates, more likely to do the economy in at some point in the future. Kind of,
right.
sort of, that's the thinking. Yeah.
But I think there's enough here to think that, hopefully the Fed will sort of see through that headline 336 gain and realize that, this isn't really quite as strong of a report as it might seem on its face.
Right, right. And should they read through it? I mean, 336,000, to my earlier point, is that one of these just one-off wacko numbers that are not consistent with other stuff, and it's more noise than signal, as they say?
Yeah, I think there's a couple of pretty significant quirks in the numbers, both in the revisions to the past 2 months, which were big, and in the current month. So the revisions to the prior 2 months I mentioned were up 119,000. If you look at revisions to private payrolls over the last 2 months, they were actually down 12,000. So that revision is almost entirely driven by government. Government payrolls were revised higher by 131,000 in July and August.
Do you know what's going on there? I didn't know that. That's interesting.
So I think most of it is in state and local government. My guess is a lot of it's around seasonal adjustment issues. That time of year is problematic always in terms of state and local government education payrolls. And so my guess is there's, still some issues there in sort of sorting out what's a post-pandemic trend versus what should we expect to sort of go back to what happened in 2019. So I think there's just a lot of noise in the data still, and not a lot of, data that's clean, that isn't sort of hugely impacted by the pandemic. And so I think there's just some uncertainty around government payrolls at this point.
Just to make sure I have this right, you're saying we had these upward revisions to payroll employment growth in the previous couple months, and that was all in government. Excluding government, private sector payrolls actually got revised down again, consistent with the downward revisions we had been getting.
Yeah, it was a very small downward revision. It was only 12,000. And there, if you look at the industry level, there were some industries that were up, there were some that were down, but they were all pretty minor. And the net result was it was down a bit in private payrolls.
And it's not like state and local governments just discovered they had hundreds, tens of thousands of more employees. You're saying it probably is related to measurement. Seasonal adjustment would come to mind. You don't know for sure, but that feels kind of sort of what's going on here.
Yeah, I mean, I started to look into it a little bit before we got on, and if you look at the sort of the unadjusted movements in state and local governments in July and August, it's hard. They've shifted obviously over time. There was big differences in 2020 and 2021 for obvious reasons, and now sort of 2022 and 2023. It's a question of it looks different than it did in 2019, and is that a sort of real difference that seasonal adjustment should be accounting for, or is it still sort of we're working our way back to some pre-pandemic trend in the unadjusted data? And so I think there's not a lot of information for the BLS to go off of at this point to figure out what's the right seasonal adjustment factor in some of these industries that move a lot month to month. And so I think there's just still a bit more uncertainty than we're used to.
Now, one of the reasons I think that we've been getting these revisions, to previous months, and they've been consistently down in pretty large. Last month, downward revisions were, I think 1 month, like July, got revised down 100K or something like that. Our thought was that it goes to response rates, that the response rate. So this is a survey of businesses, the payroll survey, and businesses are responding at a lower rate, at least initially, and they ultimately respond a month or two later, and thus the revisions. But initially they're low. Do you have a sense here was the response rate low again?
It was, yeah. And if you look, across the last 3 months, it's been particularly bad, right? So if you go back to July, the response rate for the first release of data was the lowest that it had been since 2008. In August, the actual response rate was below 60%, and it was the worst since the early 2000s, I think 2002. And then again here in September, the response rate was better. It was up to 68% roughly, but that's still the lowest for a first release of September data since the mid 2000s. I mean, response rates are pretty bad across the board right now. They do get better on the second and third release of data, but that first print that we get is more tenuous, I think, now than it used to be, given those low response rates.
Right. Interesting. Any other technical measurement issues you want to call out?
Yeah, I mean, I would say the other thing, I mentioned the leisure and hospitality jump in September. That again, if you look at the unadjusted versus the adjusted data, I think you could argue that there again, there's a big seasonal movement that happens in September all the time. There's actually a big decline in the unadjusted leisure and hospitality payrolls in September as you get the sort of shift from summer into fall. And that the size of that decline has moved around a lot here since 2019. If you look at sort of the early pandemic and then now, and I think again it's a question of what's the right seasonal adjustment factor, right? Is the data we're seeing now sort of a true representation of what it is, or is it we're still adjusting back to some normal? So I think there again, that boost that we saw in leisure and hospitality could be in part driven by that certain uncertainty in the seasonal adjustment process. If leisure and hospitality was something closer to what it's been in recent months, private payroll growth is, close to 200K again, as opposed to 260, and obviously well off that headline 336. So I think there's reason to think that, certainly if you're just looking at the headline, it's almost certainly overstating the case here for the month.
Okay, bottom line, job growth, the job market is strong, no debate, but probably not nearly as strong as the top line 336K in the upward revisions of previous months would suggest.
I would agree. Yeah.
You would agree with that. Okay. All right. Cris, any holes in Dante's rundown you want to fill in, and what's your interpretation of the numbers?
No, I think you got it. And my interpretation is similar, that directionally, sure, things are strong, but I do fear that there's some measurement error in this number. I'm not taking it at face value, and I don't expect the Fed will either. So,
right. So, okay. So you're strong, not as strong as the headline number would suggest.
Right.
Okay. Yeah.
Do you take the wage number at face value?
Well,
it's pretty good, right?
Yeah. I mean, I got to be careful that I don't spin everything positively, but
yeah.
I kind of spin it positively, right?
Yeah.
I mean, I want to see jobs. We like jobs. And the other interesting thing about the report, correct me if I'm wrong, Dante, that you didn't mention, very broad-based job creation. A lot of jobs, you're right, in government, healthcare, hospitality, leisure and hospitality. But it felt like I was looking through, the BLS has this nice table where it shows employment change by month, by industry. There's a lot of industries that were up. I don't know. There's a diffusion index that kind of captures that. I hope I'm not taking anyone's stat for the game, but is my sense of the number correct? Was it broad based?
Yes. Yeah, it certainly was, and the diffusion index was up a bit relative to where it's been in recent months. And yeah, I mean, I think if you look at major industries, the only decline was in information, which again, was the sort of actors strike issue probably still playing out there. But if you look at major industries, there was still growth almost everywhere. It wasn't huge amounts of growth, but I think in terms of looking for pockets of weakness or places where payrolls are actually declining, it's still hard to find those, which is a good sign.
Yeah. So I mean, I look at it and I see strength. In some respects, it's not surprising we would see strength. I mean, this kind of job gain, yeah, but the third quarter, the just ended third quarter, that was a pretty strong quarter. I say a really strong quarter for the economy. I mean, you do these tracking estimates for GDP, real GDP growth in the quarter based on the data flow that's coming in, the monthly data. Where are we? We're at 3.7 last I looked, or something like that. 3.7%. Yeah. That's annualized GDP growth. And just for context, the economy's underlying potential growth rate is probably around 2. That's almost double the underlying potential growth rate. So it's not surprising you'd get a solid job number. And also the other data in the job market feel pretty good, right? I mean, UI claims, initial claims from unemployment insurance remain around just over 200,000 per week, which is very low. So layoffs remain low. And the JOLTS numbers we got, job opening labor turnover survey data, we'll talk about that some more, but that looked pretty good. So not surprising that we would get strength. And here's the other thing that I think is really important and comes out when looking at the household survey. So you got the survey of businesses, the payroll survey, and now you got the survey of households. It's the basis for labor force and unemployment. The supply side of the labor market remains very strong, even stronger than the demand side that we just talked about, right? I mean, labor force growth is really very good. I mean, year over year, I was looking 2%. That's kind of double what you would get. I think we think we would get, and that even more than double. Given demographic trends and the aging of the baby boom generation out of the workforce, and that goes to labor force participation. That goes to immigrant workers coming into the workforce, and if you kind of look at the average monthly change in labor force, it's 275,000 per month over the past year. So, and that goes to the kind of the stable unemployment rate, which is somewhere between, it's been between 3.5, rock solid between 3.5 and 4% for all, at least a year and a half, probably coming up on 2 years. I need to take a closer look, but that's pretty amazing. That's, very strong, healthy labor supply. So yeah, we're getting all this labor demand, but we're also getting a lot of this labor supply, and unemployment stable. Other measures of labor market slack all are strong labor market, but stable, nothing suggesting overheating. And then on top of that, you get, as Cris said, the average hourly earnings. That's the measure of wage growth in the report. And that was pretty good. Came in, I think, what, 0.2% increase, you said, on the month?
Yep.
Year over year, what, 4 point something, 2, something like that? Year
or
over
2,
year?
yeah. It's 4.15, yeah.
Yeah, and I mean, everyone's got in their mind, every economist has in their mind, 3.5% is the right kind of number for wage growth to get inflation back to target. That's 2% inflation, and then you add in 1.5% underlying productivity growth. But I never really understood why it's 3.5. By the way, feels like it should be 4, right? 2.5% CPI inflation plus 1.5% productivity growth gets you to 4. Well, why are we using? I mean, you know what I'm saying. But I'm splitting hairs. But that's the point. We're within spitting distance of, statistical spitting distance. I like that term, statistical spitting distance. Right? You know what I mean?
Technical term, yeah.
Yeah, statistical spitting distance of target. So I look at the report. At first blush, I go, "Oh, this is going to be a bad day."
Yeah,
bond yields are going to rise, and I want to come back and talk about bond yields because that seems to be the biggest threat to the economy, in the most immediate threat to the economy. And stock prices would be down, but you look at the internals of the report, I just feel a lot better as I look deeper, and now I even feel better listening to you and hearing some of the technical factors. So I came away thinking, but again, I tend to spin things positively. I got to be careful about that, but it felt like this could be spun positively. Even you, it sounds like even you, Cris, feel the same way.
Yes. I don't. Again, you look at it at face value, assuming the data is right. There's very few blemishes here, right? If any, right?
Yeah, exactly. Right. Okay. Okay. Anything more on the employment report before we move on? And we are going to keep this a relatively short podcast because the podcast we've been having, I don't know if listeners have been. I'm sure they've noticed this, but they've been very long. I mean, like an hour and a half long. It's like movie long, kind of podcast. Getting a lot of good feedback, but nonetheless, they're pretty long. So we'll keep this one relatively short. But anything else on the job numbers that you want to call out?
I guess you alluded to the jolts, and the job openings were up a lot as well. So this would be consistent. A strong labor demand in the openings report, translating into strong payroll growth here. But I also look at that jolts number, and I'm suspicious of the validity there as well, given.
I was going to say that's another one where the big jump was almost entirely in a single industry, which always makes me a little bit apprehensive.
I didn't know that, Dante. Dante, you're like a wealth of information. I love to have you on. So what was that?
So openings were up roughly 700K over the month, but about 500,000 of that was in professional business services, which have not been particularly strong in terms of job growth recently. So I think that would be the biggest increase ever in a single month for job openings in that industry. I mean, which just feels unlikely.
Feels strange.
Isn't that where temp help is too? Isn't that temp help? And that's been declining. That seems weird.
It seems like a weird fit. Yeah. So.
Yeah. Okay. Yeah.
Again, I think the survey response rate there is
even lower.
Low.
Yeah.
Yeah, it's very bad.
Yeah. But other than that pop in job openings, which now feels, given what you just said, even less real.
Right.
Other elements of the jolts felt pretty good, right? For if you're looking at a strong job market that's throttling back. Strong, low layoffs. I view that as a very positive thing because I just don't see how you get a recession without layoffs. I just don't see it. Consumers are going to keep spending until they're spooked, and the only thing that really spooks people is that they start losing their job. And then, from a wage inflation perspective, the quit rate is all the way back into pre-pandemic, and not it is consistent with the kind of the average hourly earnings, the moderating wage growth that we've been observing. So that all felt pretty good.
Yeah.
Hiring rates, but that's back to pre-pandemic. That felt pretty good. So I thought that one was the JOLTS was a pretty good report altogether as well. I didn't mean to ask on the JOLTS while we're on the topic. The job openings. I've kind of been making this argument that it doesn't really cost businesses anything to keep open job positions. I mean, historically, the cost might have been greater because if you have an open position and you start advertising, you'd have to pay help, the local newspaper for help wanted ads. And they were expensive back in the day before online help wanted. But now there's really very low cost to, keeping an open position. And if you're a cautious business person who's been through a lot of labor shortages over the years, pre-pandemic, during the pandemic, post-pandemic, you have an incentive to keep those positions open, even though you might be slow walking the hiring. So I kind of downplay the informational value in the open positions. Dante, would you concur with that perspective?
Yeah, I think certainly in the noise of the data, and I think just in the sort of level today relative to 2020, I think there's a reason to believe that we shouldn't make too much out of the fact that openings are higher than they were 3 years ago, 4 years ago. And certainly the month-to-month volatility, I think, is probably largely driven by low response rates. If you look at the openings from JOLTS compared to like the Indeed publishes a measure of job openings as well, and they trend mostly the same. It's just that the JOLTS data is just all over the place. It jumps 500K and then falls 600K, and then so it's just very noisy relative to the Indeed measure. But they both have been trending down, which I think makes sense, and they're both generally moving in the same way, but they're still higher than they were pre-pandemic. Which again, I don't know that I read much into that for the argument that you make. It's just not that expensive to keep positions open, and firms might just be sort of hedging their bets a little more than they used to in terms of leaving positions out there.
What do you think, Chris? Do you feel the same way as I do about the job openings numbers?
Yeah, that's right. It's maybe directionally helpful, but there's some measurement there as well. Measurement issues.
Hey, one other measurement technical issue, just to get it out there. Strikes. I mean, we've been having a lot of strike action, seemingly UAW, the actors, writers strike, hospital, Kaiser Permanente. Did that have any impact on the numbers today, Dante?
So no impact today because the actor strike was already ongoing last month, and so the adjustment was essentially the same. So the net effect for September would be nothing. And then the UAW and the Kaiser Permanente strikes were too recent. They weren't they didn't encompass the full reference period in September. So those won't if they continue, they could end up showing up and impacting the October data. But there was no effect on this report from strike activity.
Okay, very good. Okay, let's play the game, the stats game. The game is we each put forward a statistic. The rest of the group tries to figure that out with questions, deductive reasoning, clues. The best stat is one that's not so easy, we get it immediately. One that's not so hard, we never get it. One bonus if it's apropos to the conversation at hand. So Dante, you want to go first?
Sure. Let's go with 3.4%.
Okay. In the jobs report?
In the jobs report, yeah.
Household survey?
Not household survey.
Okay, that means it's the payroll survey. Is it related to wage growth?
It is, yes.
Oh, wow.
Is that? Oh, I know what it is. Chris, you're going to bow to me.
Please.
I have to bow to me. It's the 3-month annualized change in average hourly earnings.
I served it out. I mean, it's one of your favorite. You love it.
Oh, you're saying that was an easy one. That's what you're saying.
For you, because it's in your wheelhouse. It's one that you think about. You've
In
used
my
it before.
wheelhouse.
In
Oh
your
my
wheelhouse.
gosh. I
You
That was
Really?
well done. That was well done.
Oh,
great,
thank you.
great job.
That's what I wanted to hear.
Just wanted a pat on the back. There you go.
It could. I was thinking.
To tell you that. Yeah.
I was in year-over-year growth rates. You know, it was
Yeah.
totally in the wrong place, and you went right to the wages. So.
Well, and that's a really good statistic, right?
Yeah.
Okay. You want to explain, Dante, why? That's very encouraging, actually.
Yes, I mean, we talked about the year-over-year growth rate is still 4.2%, but if you look recently, right, August and September, month-over-month growth was only 0.2%. Back in July, it was slightly higher, it was 0.4, but I think it was actually a little under that, unrounded. So if you take that 3-month annualized rate, it's down below 3.5%. And we talked a little about, should we trust the wage number in light of everything we just talked about with the report? And I think there's a couple of things. One, the wage number for August actually didn't really move much, and two, we talked about all the issues with government, but the wage numbers that we're referencing here are for total private payrolls, right? So any issues that are happening in government aren't going to necessarily affect the wage measure that we're looking at. So I think there's more reason to think that this, is a number that we can rely on a little bit more heavily. And obviously that 3.4%, you said there's, maybe we shouldn't be worried about 3.5% being the target that we need to get to, but certainly this is signaling that we're moving in the right direction, that wage growth is, likely to come under 4% year over year here pretty quickly, maybe get to 3.5%, maybe not. But I think it's going to be in that range that we're talking about, where the Fed is going to feel more comfortable with wage growth here pretty quickly if things continue.
And of course, the wrap against average hourly earnings, the wage measure in today's numbers is that it can be influenced by the mix of job growth by cross industry, cross occupation. So you have to be careful in using it. But having said that, the best measure, or at least the one that we feel is best, the Employment Cost Index, ECI, that's a quarterly. That'll come out
The end of the
weeks
month,
from now,
yeah.
3 weeks from now. That also has been moderating too. I think it's kind of 4 to 4.5% ish. In fact, I think in Q2 in that quarter annualized, it was 4%, I believe.
Yeah, it's definitely come in. You probably
Yeah.
remember the exact number better than I do, but yeah, it's definitely been showing a similar trend. We just don't get the update as frequently. And certainly the mix could be, we had a big jump in leisure and hospitality payrolls. Those tend to be lower paying. So there's some reason to think that maybe that's weighing a little bit on it, but we got a good number last month as well when leisure and hospitality growth was pretty sluggish. So yeah, certainly there are, issues there, but I think it's still a fairly good measure of what's going on.
And so bottom line, your sense is we're within statistical spitting distance of where we need to be on wage growth to make everyone comfortable that the Fed can hit its inflation target of 2%.
Yeah, that's the way I read it. I think it gives another, again, if you're thinking about how the Fed's reacting to this report, I think it gives another notch to say, hey, hopefully they don't overreact to that top line number.
Yeah. Okay. Got it. Good statistic. Chris, you want to go?
Sure. 411,000.
It was in the jobs report?
Nope.
Oh, geez. Now I'm totally,
Is it labor market related?
So disoriented now.
It is. Yeah. That was my plan. It is labor market related.
Is it from the JOLTS?
It is not from the JOLTS.
Okay.
And is it from UI initial from the unemployment insurance? No. Okay. Is it a report that came out this week?
Yes.
Ooh.
It comes out continuously, so it's summarized. But
and you said it's labor market oriented. No,
yes.
It's not labor market oriented.
It is labor market oriented.
It is labor market.
It's from the BLS data.
Oh, it's real time? It's kind of continually coming out.
As events transpire.
Wow, that's
something related to strikes.
Yes.
Okay.
Yes.
Oh, okay.
You're there. 411,000.
That sounds like a lot of strikers. Could that possibly be right? I mean, it is up to 411,000.
It's the number of people involved in a labor action, involved in strikes this year to date.
Oh, year to date. Okay,
year to date.
Yes. Okay,
okay. Exactly. Not once.
Yeah. That makes sense. Oh, that's interesting. And okay, I guess it's up quite a bit from where we've been historically.
It's up a lot from certainly where we were in the last few years. It's about 3 times the average over the last decade. So it's a lot. But at the same time, we had in 2018, 2019, there were also big years for strikes. We're also in this 400,000 range.
Oh, is that right?
Yeah, and if you go back to the 90s, right, we were in this range as well. So I think there's a lot of strike activity going on. Certainly, it's having an impact, but I think the anomaly might not be so much that it's higher now. The anomaly might have been that it was just so low over the last decade. So, like all things we're seeing, there may be a reset in our baseline, right? As we talk about the 10-year or other rates as well. So I just wanted to call it out as now there's a lot of talk about labor actions. I don't see them as being the real driver of some of the statistics we're seeing in the economy when it comes to wages and whatnot. So it's still a relatively small share.
Yeah, that makes sense to me. It would be surprising if we didn't see more labor market action. I mean, the labor market is strong, and so the kind of the power dynamic between workers and their employers is more balanced than it has been in a long time. So not too surprising. And actually, the actions have been less kind of disruptive than I had thought. Like at least a good example is the UAW strike. At least so far, obviously that's still ongoing. But when it first started, the fear was it would be that there'd be broad-based strikes, shut down the activity of all activity of the big three automakers, and we're not even close to that, right? I think we had a macro meeting this morning, and Mike Brisson, our out analyst, was saying I think it's 17,000 workers that are now out at the UAW, and they have 145,000 all in. So it's still very modest by that standard. Yeah. Okay.
Yeah, it'll be interesting to see how these actions play out. Is this the better strategy for both sides? Right, kind of more of limited versus kind of the nuclear option. You just go all out. So we'll see. But you're right. Okay. The other strikes this year, with some exceptions, of course, they seem to have been resolved in fairly short order.
Well, like I lost a little bit of track. The actors writers strike, is that it's been settled, right? Or
the writers strike has
the writers settled. Has, but not the actors. Right. Okay. All right. Ready for mine?
Yeah.
80.8.
Some participation rate.
It's not a participation rate.
That employment population ratio.
It is indeed.
Is prime.
Prime. Okay. Yeah. Too easy. I knew it was going to be. Damn.
It was down a little bit.
Yeah.
Okay.
Yeah, it ticked down, and it's no higher than it was from the beginning of the year. So it's kind of where you would think it should be by looking at history, consistent with a full employment economy, but no higher than that, no lower than that. Feels really good, and it's stable. Very, very stable since the beginning of the year, along with the unemployment rate. So another indication that just consistent with the idea that the labor market's strong, but not overly strong, not, blowing past full employment, and kind of where you'd want it to be. It's like a really good labor market, feels very good. Okay. And I like looking at the prime age. That's 25 to 54, because that's kind of the teeth of the labor market, right there. Okay. Let's, I do want to talk a little bit about something you brought up, Chris, earlier about at the start, your emotions getting swung around here by all kinds of things going on. And one thing that's moving around a lot is long-term interest rates. In fact, do you know, at the beginning of the day when the numbers came out, bond yields really took off. I think they were up at some point 15 basis points, 0.15 percentage points. That's a big move in the long-term interest rates. Do you have any sense of where we are right now? And also in that context, has there been any change in market expectations for a Fed move, another rate hike at the next meeting in November?
Yes. So real time as of 11:30 on Friday here, we're at 4.78 on the 10-year.
Oh,
so you're right.
Boy,
they shot up
back in.
They've come back in. They're still up about 6 basis points.
6 basis points. Okay.
From yesterday. And then on the Fed, I did notice this morning that the odds of a hike in November or December have gone up based on the CME Fed watch tool, right? Somewhat. It still the majority, about 69-70%, is still calling for a pause.
Okay.
But it's about a 10% increase in the part of the market that believes there will be a 25 basis point hike. So,
well, while you're looking at your screen, what about stocks? Because there was a lot of red early on after the release.
Yeah. What was it? It's turned green.
Turned green.
Yeah.
Oh,
a little bit. It's not screaming green, but yeah, it was down, but now they're back up a bit.
Okay, so markets are kind of
digesting
it the same way we are. It sounds like.
Yeah, I think so.
Okay.
Kind of looking through.
They're looking through it and saying, okay, there's stuff going on here, and I'm looking at the wage growth, and that feels like that's what we need to get inflation back in the bottle and keep the Fed at bay. Okay, well, that's good.
If you want oil too, oil's flat.
Oh yeah, oil's down too. Yeah,
flat. It's
flat,
$82 and change.
And of course, that's down like $10 a barrel, right, in the last week or something.
Yeah.
Yeah,
few
which
days.
is good news, right?
Yes.
Okay, so let's talk about the run up in interest rates. And by the way, 6 basis points, that's still a lot, but that's not. This bond market's been moving 6 basis points every 30 minutes. It feels like, it's highly volatile.
Yes.
So the 10-year treasury yield is what, 4.8%, something like that? Probably, if it's up 6 basis points. And, that's up what, over 100 basis points, more than a percentage point over the past couple 3 months. I would think we were kind of in the mid to high threes back in spring, summer. Now we're up, let's say 100 basis points, maybe a little bit over that. How worried are you about that, Chris, in terms of what it means for, economic growth, for the economy? How big a threat is that to the economy?
I think it certainly will weigh on consumers and businesses. The most obvious channel, when I've been getting asked the most about this week, is the mortgage market, right? With the spreads on mortgages have been averaging around 300 basis points. So this puts us on track for something close to 8% mortgage, assuming the 10-year does rise to about 5% here. And that's a big movement. That continues to eliminate the population that can actually afford a mortgage, or reduce the population that can actually afford a mortgage at the prevailing rate, given the level of house prices. And it's not just the existing home sales that we're seeing; it's increasingly more the new home sales that are getting taking on some of this decline, and that goes right to builders and GDP and jobs potentially. So I don't think it's crisis moment yet, but certainly if we continue down this path, it's going to continue to impact that sector. And then more broadly, right, the higher borrowing costs are going to impinge on the ability of businesses to hire, to expand as well. So I think it's going to slow things. Again, it seems as though there's enough dry powder here to offset some of the effects, so it doesn't push us right into recession, but it certainly slows things down.
Yeah, I'm hard pressed though to get overly worried about it. I mean, you pointed to the one sector of the economy that's the most rate sensitive sector of the economy, single family housing. And you look at single family housing, and it feels like it's kind of sort of navigating this pretty gracefully. I mean, home sales are down, right, a lot because of all the interest rate lock. So the fixed mortgage rate at closing in on 8, the average coupon in an existing mortgage, if you look at all the mortgages out there that people have, it's 3.5%. So people have no there's a strong economic incentive not to move, right? Because I've got this 3.5% mortgage. If I sell my home to go buy another home, get another mortgage, I'm going from a 3.5 to an 8. My monthly payment's just going to be unaffordable. So I'm not moving. So home sales are in the deep freeze, but they weren't the deep freeze back at 7%, so I'm not sure. In terms of its economic impact, that's relatively modest. And then you look at home.
That's on the supply side, right?
On the supply side.
Yeah. So you don't, yeah. I wasn't going to move at a 6.5% mortgage. I'm not going to move at 7.5. I'm not going to move at 8.
Yeah.
Right.
Yeah.
So,
Yeah.
but on the demand side, right, the affordability side, those renters who potentially could have come in to purchase homes, well, they increasingly are just set to the sidelines. They're really locked out of the market.
Oh, sure. And I'm
They
not
can't
arguing.
afford.
Yeah, I'm not arguing that's
Yeah.
good. It's bad. I mean, it weighs on home ownership, but I don't know that in the near term, as a near term threat to the economy, it's that big a deal. I mean, the big deal would be if you saw a big decline in housing construction, single family housing construction. And as you pointed out, we have not seen that yet because builders have responded to the increase in interest rates and weakening in affordability by effectively cutting, I think this is right, effectively cutting their price on the home, right? One way of doing that is buying down the mortgage, right? So buying down meaning the home builder will cover, a point or two of the mortgage rate increase for a year or two to keep the effective cost down, the effective price down to make this more affordable for you. And that's helped to keep new home sales up reasonably so and kept single family housing construction from caving. And that would be I think probably the biggest most significant channel through which interest rates would affect the housing market, which would affect the economy. Is that fair?
Yeah, I guess we could debate how much more room they have to give in terms of the incentives, but yeah,
right. But so far they've cushioned the blow here, right, to the economy.
Yeah.
Right. And you can actually go back to the jobs report, look at construction employment. Obviously, a lot of different things going on there, but the weakening in single family home building hasn't been enough to offset the job growth in the other parts of construction. Part of that's fiscal policy, part of that's multifamily, and you're still getting positive construction employment growth. And that's the most rate sensitive sector of the economy. Right.
Yeah.
So
far.
So far. Yeah. So far. You're right. So far. I mean, but I guess if that's the most significant channel through which higher long-term rates are going to affect the economy in the near term, doesn't feel like it's that big a deal if it's, 4% or 4.5% or even 5% on the 10-year yield. No?
Well, I guess we've made this point in the past. On its own, sure, we might be able to digest it. Labor market stays relatively robust, but we've got some other headwinds here potentially as well. So that's
I do worry about the higher rates in the context of the second thing you said, and this is more down the road. It's not like in your face, and that is rates are higher. So any debtor, whether you be a business person or a household, a commercial real estate owner, with a loan that's coming due, it's maturing, and now you've got to re-up your mortgage or your loan, and it's going to be at a much higher interest rate, probably under more onerous terms because the banks have tightened down given what happened back in March. That raises the risk that the business or the household or the property owner can't manage the higher interest payments and therefore defaults. And that hasn't happened yet, but feels like if rates stay high for too long and more debt starts to roll over, you could see that happen. And that's, to me, the real concern. But that's not a concern for the fourth quarter or the first quarter. That might be a concern over the next couple of years, depending on how high rates remain and how long they remain there. Is that fair?
That's right. So for the existing borrower, that's true then. But the constraint is on the new borrowing, of course, right? Any new activity, I need to borrow to start a new business or expand my business, right? I'm going to face this higher rate. So it certainly could restrict additional spending or investment activity.
But it feels like this is a corrosive, not a cliff. It doesn't feel like this is a stake in a dagger in the heart of the economy. It's one of those things that it's just like a weight on the economy. At some point, the economy breaks underneath, but it's not one of those things that does us in. It's not a catalyst for recession, I guess is what I'm saying.
On its own, right?
Yeah,
I'd agree with that.
Yeah,
you need to combine it with something else, right?
Yeah. Dante, you've heard the conversation around long-term rates. Anything you want to weigh in here on or say? I've got one more thing I want to say, but before I say it, I want to just pass it over to you.
No, I mean, I would agree. I don't think it's not a signal of a cliff event coming. I think it's that headwind, and it's a question of, how long can we run against that headwind, and does that eventually cause us to stop moving forward, right? Is that eventually enough to sort of cause the economy to roll over? Does something else happen at the same time that sort of adds to that headwind? So yeah, I agree. It's not this sort of singular event that's going to cause everything to fall apart, but it adds pressure, and eventually over time that could cause problems.
Right. Okay. Obviously it raises the cost of capital and business investment gets hurt, and it's not good. I'm not arguing it's not a headwind, but it doesn't feel like a headwind that can blow us over here in the near term. Here's the other thing, and that is, if you look at the reasons why long-term rates have risen, the kind of frame, and I think we've talked about this before on the podcast, the framework I use is, I decompose the 10-year yield into three parts. Part one is inflation expectations. What do bond investors think inflation is going to be in the future? They need to be compensated for that. Two, what do they think the Fed's going to be doing? That goes to short-term interest rates, particularly after inflation, expected real short-term interest rates. And three, the so-called term premium, which is the difference, is the amount of yield, interest rate, long-term an investor in a long-term bond needs to compensate for taking the risk compared to investing in a short-term bond, given all the things that can, affect interest rates between here and in the long run. And if you look in the recent run-up in long-term rates, none of it is related to inflation expectations. That's been stable as a rock, and to the Fed's credit. Right where you'd expect it to be, right where you'd want it to be. The run-up in rates is largely around the Fed and real short-term interest rates and the so-called term premia. And I feel less worried about that than if it were inflation expectations. If it were inflation, because one reason yields are up is because bond investors say growth is going to be stronger, therefore the Fed's got to keep rates higher for longer. So it's almost like saying rates are up because the economy's strong. Therefore, it's less likely the higher rates is the thing that's going to do the economy in. Am I making any sense at all? Do you see what I'm saying? I mean, if it was inflation expectations, you'd go, oh my gosh, that's a problem. Yeah. The Fed's got to go on the warpath, jack up interest rates even more, and we're going. This is going to push us into recession. But if it's not inflation expectations, I feel less worried about it. And here's the other thing on the term premium. That's a melange of stuff. It's hard to disentangle all the things that are driving that term premium. I'm sure some of it is concern about the fiscal situation or budget deficits, and that came to the fore after the debt limit debacle earlier this year, because the Treasury had to issue a lot of debt to kind of catch up, and that kind of conflated with the Fed's quantitative tightening, meaning they're allowing the Treasury securities and mortgage securities on their balance sheet to run off. That kind of adds to the supply. All those things, are part of it, but it's also just speculation in the bond market. The bond market is a market. It's a financial market like the stock market, and it's infected by momentum players, speculators, technical factors, short sellers, all kinds of wacko weirdo things going on that are not fundamental. They can drive a market for a while, but they can't drive it forever, for very long, because the fundamentals will ultimately prevail. And I suspect a lot of this run up in yield is those momentum players, like the Bill Ackmans of the world, they're tweeting about this, or the other Larry Fink or Jamie Dimon talking about long-term rates kind of fans the kind of the speculation and the momentum players in that market. So I worry less about that. So I guess my point is I'm less concerned about the run-up in interest rates because of the reasons why interest rates have risen. Okay, I'll stop. I went on a bit of a rant. Chris, does that resonate at all?
It does. It does. I guess one point I would kind of push back a little bit on is just the inflation expectations. You're right; they are anchored, and they've been the run up in volatility that we had has seemed to be dissipated, but they are higher than they were prior to the pandemic. So that would suggest that this is a new old regime. or of some sort.
Rates are going to be higher now. I mean, I would say they've normal. That's just normalization, right?
That's right. Well, I guess
the weird thing was before, right?
Exactly. Back to my earlier point, right?
Okay.
So I think you agree there that we're not going back to 2-3%, right, as the normal. That's not the
yeah. No. Right. In fact, I would argue that 2-3% was the one
abnormal.
thing that abnormal was unhealthy. It was not. That's you. When people said, "Is the economy back to full swing after the financial crisis?" I would always say, I would argue no, because interest rates inflation had not normalized, and interest rates had not normalized. But now they feel like they've normalized.
Yeah. Okay.
Okay. And here's the other thing, and you can attest to this, Chris. We have had in our outlook for long-term interest rates kind of a 4% 10-year treasury yield. That's kind of been the stake in the ground in our forecast. And if you go back pre-pandemic, we had that forecast, and of course back then rates were a lot lower, and we came under consistently withering criticism from clients and others saying, what are you talking about? We're never going to get back to 4%. But we had the 4%, and right now we're 4.8, which is a little, it's higher than 4. But going back to I think this is going to be the title of our podcast. It's within statistical spitting distance of 4%, given that the bond market moves 10 basis points in an hour, right? I mean, am I wrong?
Yeah.
When the 10-year was 4.1 just like a month ago, at the beginning of September, it was basically a 4.1. I mean, you're talking about a huge movement in a month. And so you expect some of that could easily come back off just as quickly.
Yeah. So, I think I don't get hair. I certainly don't get hair on fire. I'm not even sure how worried I should be at a 4.8. If it goes to 5 and above and stays there, then we got, that's going to be a problem ultimately. But if it, 4.8 goes down to 4.5, 4.25 over the next few months, I'm not sure. Big deal. Agreed? We're roughly so? No?
I guess it's the speed and duration, right?
Okay.
We can adjust to anything, right? Pretty much. But
I can't adjust to anything. Everything's got to be exactly the same for me. I got to get my Wawa coffee every morning. If I don't have my Wawa coffee, I got a problem. So nothing's got to change. Nothing can change.
Fair enough.
I can't adjust to anything. But anyway, I get your point. Now, Dante, he can adjust to anything. That guy,
he's dynamic.
Nothing bothers that guy. I'm telling you. He's like
even keel. That's what I shoot for.
I know. Yeah. I got to meet your wife. I mean, she must be bouncing off the walls. Yeah.
It's not as even keeled as I am. That is true.
Really? Oh, that's scary. Scary. What about your kids? They must be. They're the guy. They're bouncing off the walls, I'm sure.
Well, no? Yeah. I think age has more of a role in that than their actual personality. But yeah.
Okay. All right. Okay. Very good. Hey, one last thing. Chris, oil prices. That's the thing that had been really making us nervous. Are you less nervous now that oil prices are down or not? It's just too early to feel good about that. Because oil was, I think it was just last week we were talking about this. Oil was 90, 95 bucks, and it felt like it was going to 100. Now it's 80, 85 bucks. And at our macro meeting again, we're talking to Chris Lafakis and Juan Pablo. Oh, Juan Pablo wasn't there. Chris Lafakis, and he's saying he thinks this is real, that we're going to be in the 80s. Does that make you feel better?
If it's true, it makes me feel better.
Okay. Right.
I'm still nervous though, right? That market, of course, was subject to all sorts of movements.
So. I know. Okay. But I'll take it, right?
Yeah, absolutely. I'll take it. If we can stay in this range, I think we can manage. If we can keep the 10-year in this range, I think we can manage. It's
well, the other good point he made that hadn't resonated with me until he was telling me this a few days ago. Gasoline prices have actually remained, even though oil prices have gone up, gas prices have not. And that goes to, the fact that we're in a seasonally weak period of gas demand, the less driving, and the so-called crack spread, the kind of spread between what refiners charge for the refined product and the crude is very, very wide and probably going to come in. And that's going to keep gas prices down. Gasoline, diesel, jet fuel, cheaper, relative to oil than at least for the next few months, that's going to be the case. And that's also very positive. Yeah. Okay.
I think I saw a statistic that we were actually using less oil or less gasoline today than we were back in 2019.
Yeah.
Is that
I think that's definitely true. Yeah.
possible?
I mean,
So
yeah. Oil consumption here in the US is about 1 million barrels a day less
lower.
than what it was pre-pandemic. Yeah. So
Yeah. So
moving in the right direction. Okay, let's end with the probabilities of recession. I don't think I've done this with Dante. Well, since you were last on, Dante.
Yeah.
What is your probability of recession? Let me tweak it a little bit now, because we're now in October. What is the probability that a recession will start at some point between now and the end of 2024? So on the other side of the presidential election.
I don't think it changes my expectation. I mean, I think a month ago I was at a third, and I would certainly nothing today has changed that. And I don't think, I think things have settled enough over the last couple of weeks that I would still say a third.
Okay. And Chris?
I'm gonna stick with 45%
45
chance.
Okay.
Yeah, it's just too many things moving around. Shut down, still on the table here. So
Yep.
a lot to worry about.
Okay. Now I'm still at 1/3. I was at, I'm at just to be clear, I was at 30% in the coming year. And then if you add in that one additional quarter end of next year, so one, just probabilistically, 1/3. Okay, very good. Anything else, guys, before we call it a podcast? I think this one turned out to be at least an hour or so. No matter what we do, it's going to
keep it under an hour.
Yeah.
Can't keep it under an hour. Yeah. But anything else you want to bring up?
Look forward to having Marissa back.
Yeah, I can't wait to hear about her trip to Japan. I mean,
Yeah.
that'll be really interesting. Hopefully she's having a good time. Dante, anything?
No, I'm good.
Okay.
Pleasure being here.
Yeah, thanks for coming. Really appreciate it. And I'm going to be on the road, hopefully, next 3 weeks, really for the next month or so. I'm kind of the Asian, European, Middle Eastern tour. So, but I'm dedicated no matter where, no matter when I do the podcast. I haven't missed this podcast for 2.5 years plus, and I don't plan to miss it anytime in the near future. So one of the funnest things we do every week. So with that, dear listener, we're going to call this a podcast. Take care now, everyone.